In this video, I'm going to explain to you how you can use moving average to improve your trading. Whether you're a beginner trader or you have been trading for multiple years, you probably have heard about moving averages. But how can this indicator assist you in your trading? That's what I'm going to show you. In this particular video, I'm going to be using as an example 21 bar EMA, that is exponential moving average. Exponential moving average just reduces the lag by applying more weight to recent prices. Just a side note, 21 bar EMA is the most popular moving average amongst professional traders. With that being said, are you ready? Okay, let's go. The first way how you can use moving average to your advantage is the trend identification. When the EMA is pointing down, the trend is bearish. That means the market is making lower highs and lower lows, and you should be only looking for opportunities to sell. When the EMA is pointing up, the trend is bullish. That means the market is making higher highs and higher lows, and you should be only looking for opportunities to buy. This is pretty basic stuff, right? But how can you use this information to your advantage? Well, first you need to understand about the market is the fact that the trend never goes straight up and never goes straight down. There are multiple corrections and pullbacks along the way. And this is when we will use EMA to help us identify high probability entries. When the market is trending, we as traders want to know when the correction is over and the trend is ready to resume. And this is when 21 bar EMA helps us. Every time prices get to the EMA, we can expect the end of a correction and the chance to get back and follow the trend. You can clearly see that every time prices touched the EMA, the trend resumed and it resulted in a winning trade. As an example here, and here, and here, here, alongside EMA here, from EMA here, and bounce from EMA right here. On the next slide, you can see how much harder it actually is to identify proper entries without using EMA. It's not that clear, is it? So this is clearly an important information. EMA is very helpful for us. This is much harder. This is much clearer. We can see why the bounces occur where they occur. One more without the EMA, not that easy to see. And the same thing goes for downtrend. Every time prices touches the EMA, there is a high probability that the correction is over and the trend will resume. You can see a bounce from EMA here, market is making lower highs, lower low, EMA is pointing down lower, and multiple bounces from EMA are continuing in the trend. So this is a valid strategy that a lot of professional traders use, and you can use it to your advantage as well. Couple more examples here. More bounces from EMA continuing higher, and another example I have marked. More bounces. Look at this, so many bounces from EMA that are continuing in the direction of a trend. So EMA is clearly an important tool that we use in our day trading strategy. The second way you can use EMA in your trading is the fact that EMA acts like a magnet. Every time prices get far away from the EMA, there is a high chance of prices snapping back to the EMA or just pulling back a little bit. Professional traders use this fact to look for setups to pick tops or bottoms. In this picture you can see a trend working lower, and look at this bullish bar, how far away it is from EMA. This is multiple points. And remember, prices don't stay away from EMA for a very long time. EMA acts like a magnet and it is pulling prices together. You can see this is what the picture resulted in. The prices snap back to EMA just a little bit. It doesn't have to be full snapback to EMA, but it is going to be at least a little bit of a correction. Another example, this bearish bar so far away from EMA, multiple points, and it resulted in nice snapback to EMA. Even in this particular example resulted in reversal. Another example right here. This is very far away from EMA, multiple points. Prices spiked back to the EMA. And another example, prices are very far away from the EMA, and prices don't stay away from EMA for a long time. The EMA serves as a magnet and is pulling prices together constantly. You can see another example right here, how prices are far away from EMA. This is very far away from EMA, and prices will eventually go back to the EMA. In this instance, you probably could have shorted this, but beginners should always wait for lower highs. This is much higher probability setups. You won't get as big of a move, but if you're a beginner trader, you don't want to pick tops or bottom, you want to wait for more higher probability setups, and this is lower highs or lower low, or higher low in case you're buying. But just as I said, professional traders use this fact to look for a setup to pick tops or bottoms, especially in trading ranges. Now, picking tops or bottoms is very suboptimal strategy and should be used only by very experienced traders. Beginners should in no way try to pick tops or bottoms until they have learned to read the market properly. The third way to use EMA is what I call no trade zone, congestion. This is pretty obvious just by the bar stacking up next to each other, bar by bar. But every time you see bars stacking up and EMA is flat in the middle of those bars, this situation is called congestion. And you cannot trade this, you cannot take trades in this. You have to wait for breakout and fade the breakout. So on the first picture you can see bars are stacked up next to each other and EMA is flat and it is in the middle of the bodies of the bars. You need to wait for breakout and fade it. Once again, EMA is flat and it is in the middle of the bodies of the bars. This is no trade zone, this is a congestion and you will get chopped into pieces into this. Couple more examples. First on the left side, EMA is flat in the middle of bars. The best way to trade the breakouts is to fade them, the breakouts from these congestions. Once again, you have no trade zone here, EMA is flat, it's in the middle of the bodies of the bars, and you want to fade the breakout. And the last picture, once again, very similar to previous ones. Bars are side by side, EMA is flat, and it's in the middle of the bodies. So this is a no trade zone. This is how EMA serves you. Every time you see EMA flat in the middle of those bars, no trade, you have to wait, especially if you're a beginner trader. And the fourth way to use EMA is for reversal recognition. Reversal recognition is a big topic in itself, but I'm just going to cover how EMA helps us to find good entries when the trend is reversing. The first important factor when identifying reversal is that there has to be a break of a trend line and a retest of a new extreme. After a new extreme, when prices spike through EMA, the way EMA holds prices next is the key factor to entry. So on the picture on the right side, the trend is working lower, you have a break and a retest of a new extreme. New extreme bar marked by this ellipse, and once the prices spike through EMA and hold back on the EMA, this is what I call a stepping stone. This is a part of a reversal pattern. You have a break, you have a new low, prices spike through EMA, and the EMA holds as a stepping stone, kind of as you are walking up the stairs, one leg up and your second leg moves up higher. More examples here. First on the left side, trend is working higher, you have a break, attempt to a new high, this is the rules of the trend line, prices spike through EMA, and now EMA holds as a stepping stone. This is of course upside down, but it's the same principle. This is when you can use EMA to spot reversal entries, very high probability setups. Once again, trend line is working higher, you have a break, you have a new extreme, prices spike through EMA, pull back, and serves as a stepping stone. EMA once again holds, and you can trade this entry in the direction of a reversal trend. Once again, the last picture, trend is working lower, you have a clear break and a new extreme. This is the rule of the trend lines. As a price action trader, you need to be familiar with. Prices spike through EMA, and the EMA holds as a stepping stone, as if you're walking up the stairs. This is an entry for you, this is a signal for you. When the prices are holding on the EMA, you can take the trade in the direction of a reversal. Just remember, Indicators are just a part of your skills to analyze the chart. You don't want to rely on them. They're just a tool in your toolbox when you're reading the price action. You don't want to solely rely on indicators. You just want to use them as a tool and implement them in many of your rules. I wish you safe trading. Bye guys.